When CrowdStrike's faulty update crashed 8.5 million computers in July 2024, their stock plummeted 20% in 2 days. But here's what Wall Street doesn't want you to know. 12 months later, that same stock had surged 61% above pre-crash levels. Meanwhile, Equifax's stock fell 60% after their 2017 breach, but fully recovered within 2 years. The relationship between cybersecurity incidents and stock prices isn't what you think. Today, I'm revealing the hidden patterns that separate market winners from permanent losers. Stay tuned. Let's start with a number that should terrify every CEO watching this. $4.88 million. That's the average cost of single data breach in 2024. According to IBM's latest cost of data breach report, this represents a 10% jump from the previous year, marking the largest annual increase since the pandemic. But here's where it gets interesting for investors. The cost isn't just about immediate damage control. The increase comes from lost customers, business disruption, and expensive cleanup efforts after breaches, as the ripple effects from cyber attacks continue to worsen. For perspective, healthcare organizations face the highest cost at $9.77 million per incident, while financial services average $6.08 million. According to the 2025 EY cybersecurity study, our analysis shows a direct correlation between share price declines and cybersecurity breaches. In the days following a cybersecurity incident, company stock prices decrease not just upon disclosure, but extending to 90 days after the incident. Here's what most alarming about recovery. Only 12% of breached companies fully recover, and even they need over 100 days to get back to normal. This disruption period hammers quarterly earnings, which is exactly what Wall Street watches most closely. Understanding these baseline costs gives investors the framework to predict which companies will struggle versus those positioned to weather the storm. But raw costs tell only half the story. Let's examine how markets actually respond. Here's the paradox that confuses most investors. Cybersecurity incidents should logically crater stock prices. Yet, the data reveals something completely counterintuitive about market behavior. Share prices bottomed out 41 days after breach disclosure, sinking negative 1.4% on average, according to Comparitech's analysis of 118 New York Stock Exchange listed companies. But here's what's fascinating. Share prices recovered to their pre-breach disclosure levels 53 days after a breach. The market's reaction varies dramatically by industry. Healthcare companies took the biggest hit to their share prices, which underperformed the Nasdaq by negative 10.6% in the 6 months following disclosure, followed by finance with negative 6.4% and manufacturing negative 4.0%. Retail was the most resilient sector, with share price outperforming the Nasdaq by 7.29% positive after 6 months. What's even more surprising is the sensitivity paradox. Breaches involving high sensitive data like social security numbers had less of an impact on share prices than those involving less sensitive data such as email addresses. This suggests Wall Street may not fully understand cybersecurity risks, creating opportunities for informed investors. Smart investors can exploit these sector-specific patterns and market misunderstandings to position themselves advantageously during cybersecurity events. But timing these moves requires understanding the hidden factors that drive recovery speeds. The difference between companies that recover in weeks versus those that struggle for years comes down to 3 critical factors most investors completely overlook. First, the speed of internal detection. Internal detection shortened the data breach lifecycle by 61 days and saved organizations nearly $1 million in breach costs compared to those disclosed by an attacker. This translates directly to faster stock price recovery because markets reward transparency. Second, the deployment of AI and automation. According to the IBM Cost of Data Breach Report 2024, organizations that extensively deployed security AI and automation saved an average $2.2 million per breach. Companies like CrowdStrike and Palo Alto Networks that showcase advanced AI capabilities often see their stocks rebound faster because investors view them as future ready. Third, law enforcement involvement. Here's counterintuitive finding from the IBM study. Costs dropped dramatically when law enforcement investigators were involved. Without law enforcement involvement, the cost of such ransomware breach is $5.3 million, while with law enforcement involvement, it drops to $4.38 million. According to research, customers and the stock market are reassured by a CTO who communicates about the company's existing cybersecurity mechanisms quickly and effectively. Companies that check these three boxes consistently outperform market expectation during recovery, making them attractive investment targets post-incident. Now let's assume how cyber stocks themselves behave during these market-wide security events. While victim companies struggle with falling prices, cybersecurity stocks experience something remarkable. They often surge during major security incidents, creating predictable profit opportunities. According to the Fortune Business Insights report, the global cybersecurity market size was valued at $193 billion in 2024. The market is projected to grow from $218 billion in 2025 to $562 billion by 2032, exhibiting a CAGR of 14.4% during the forecast period. The massive growth is driven by escalating threats. In 2024, we witnessed data breaches targeting large companies like AT&T, Fidelity, Dell, and Snowflake. Each major incident increases demand for security solutions. CrowdStrike provides a perfect case study here. Despite causing global IT chaos in July 2024, CrowdStrike stock has shot up 61% since the incident on July 19 last year. The company's AI-powered platform and rapid response to the crisis actually reinforced investor confidence in their technology. The revenue generated from sales of AI tools within the cybersecurity space is expected to jump by more than 4 times between 2024 and 2030, generating $134 billion in annual revenue at the end of the decade. Major security incidents creating buying opportunities in cybersecurity stocks as demand for protection surges across all industries. But not all cybersecurity investments are created equal. Let's decode the winners. 3 specific types of cybersecurity companies consistently outperform during market downturns. And understanding this hierarchy is crucial for maximizing returns. First, platform consolidators like Palo Alto Networks dominate. According to CEO, platformization has driven larger deals with customers. Palo Alto Networks recently supported 74 contracts at over $5 million, up 25% year over year. The strategy of bundling multiple security solutions creates stickier customer relationships. Second, AI-powered detection companies command premium valuations. According to the IBM study, 75% of CISOs say their organizations experienced a decrease in cybersecurity incidents following increased investment in AI. Companies showcasing measurable AI effectiveness, like CrowdStrike's Falcon platform, attract institutional investment. Third, identity management specialists are experiencing explosive growth. Identity has become a growing target of cybersecurity threats. According to a survey from the Identity Defined Security Alliance, about 90% of the respondents said they suffered a breach. The key metric investors should track is annual recurring revenue growth. According to company reports, SailPoint reported annual recurring revenue of $813 million in 2024, up 30% on a year-over-year basis. The number of customers that generate more than $1 million in annual recurring revenue grew by 67%. Focus on companies showing strong annual recurring revenue growth, AI integration, and platform consolidation strategies for the highest probability investment success. Understanding these patterns helps, but timing your entry requires reading specific market signals. Professional investors use 5 specific indicators to time their cybersecurity investments, and I'm about to share the exact signals they watch for maximum profit potential. Signal 1: Staffing shortage announcements. According to the IBM Cost of Data Breach Report 2024, more organizations faced severe staffing shortages compared to the prior year and observed an average of $1.76 million in higher breach costs than those with low level of no security staffing issues. When companies announce cybersecurity hiring freeze, their stock typically rise. Signal 2: Major client acquisitions above $5 million. These deals indicate market confidence and recurring revenue growth, leading to analyst upgrades. Signal 3: AI integration announcements with measurable results. According to the IBM study, organizations that extensively deployed security AI and automation saved an average of $2.2 million per breach. Companies providing concrete AI effectiveness data see immediate institutional buying. Signal 4: Regulatory compliance wins. According to the IBM study again, for financial industry enterprises, costs are even higher. Companies now spend $6.08 million dealing with data breaches in finance, which is 22% higher than the global average. The solution that demonstrate compliance capability attract institutional investors. And Signal 5: Partnership announcements with cloud providers and major enterprises, which signal scalability and market validation. Monitoring these 5 signals provide early warning systems for profitable entry points before major price movements occur. But even with perfect timing, certain valuation traps can destroy your returns. The cybersecurity sector is littered with overvalued stocks that burned investors despite strong business fundamentals. Here's how to avoid these expensive mistakes. CrowdStrike provides a cautionary tale about valuation discipline. The stock now costs 141 times what the company actually earns. That's way higher than what CrowdStrike actually costs at 106 times, and much more expensive than an average tech stock at 28 times their earnings. The key is understanding price to sales ratios relative to growth rates. Sustainable cybersecurity stocks typically trade at 3 to 5 times annual recurring revenues when growing at 30% annually. Anything above 7 times requires exceptional growth to justify. Market cap relative to total addressable market provides another crucial metric. CrowdStrike sees its total addressable market increasing to $250 billion in the next 3 years from $116 billion last year, driven by new catalysts such as AI. The timing trap affects even quality companies. When Palo Alto Networks CEO first introduced platformization in February 2024, the stock got crushed, losing more than 28% in one session. However, patient investors who understood the strategy's long-term value were rewarded when shares hit record highs. Disciplined valuation analysis combined with strategic patience allows investors to acquire quality cybersecurity stocks at reasonable prices. Armed with this knowledge, let's examine the specific opportunities available right now. Right now, in August 2025, specific cybersecurity stocks are presenting once-in-a-decade buying opportunities, but you need to act on current market dislocations quickly. The 2025 EY cybersecurity study shows a consensus on the importance of cybersecurity among executives and correlation between share price declines and cyber breaches. The executive awareness is driving unprecedented budget increases. The staffing crisis is creating massive opportunities. 53% of organizations that experienced a data breach in 2024 reported significant shortages in their security staff. Companies that can demonstrate talent acquisition and retention will command premium valuations. Government initiatives are accelerating demand. Recent Treasury Department cyber incidents and increasing national security concerns are driving federal spending on cybersecurity solutions, benefiting public companies with government contracts. The quantum computing threat is creating new market categories. Google achieved a breakthrough with its Willow quantum processor at the end of 2024 when it demonstrated significantly improved error correction and scalability in quantum computing. The breakthrough is accelerating investment in quantum-resistant encryption technologies. According to the IBM study, 63% of organizations stated that they would increase security investments following a breach, indicating sustainable demand for the foreseeable future. Current market conditions are creating exceptional entry points for long-term cybersecurity investments across multiple growth vectors. Now, let's wrap up with your specific action plan for capitalizing on these insights. The data is clear. Cybersecurity incidents don't just move stock prices. They create predictable patterns smart investors can exploit. We've seen how the average $4.88 million breach cost drives market reactions, how recovery timelines follow specific patterns, and why certain cybersecurity stocks surge during market-wide security events. The key insights for your portfolio is focus on companies with strong internal detection capabilities, AI integration, and platform consolidation strategies. Watch for the 5 market signals I outlined, avoid valuation traps by maintaining discipline, and take advantage of current market dislocations. With the cybersecurity market projected to grow from $219 billion now to $563 billion by 2032, positioning yourself correctly in the sector isn't just an opportunity, it's essential for long-term wealth building. If you found these insights valuable, please hit the like button and let me know in the comments which cybersecurity stock you're watching most closely right now. Hit the subscribe button to subscribe to the channel for more deep dive analysis, and make sure to download my free executive white paper on the complete guide to cybersecurity investment strategies. The link is in the description and it's completely free. See you then.